All right, ladies and gentlemen, here I have pretty much the plan for passing funded accounts. Deadline. I don't have a deadline because it doesn't matter. Because I just don't have a deadline. I feel like this is just a strategic way of me passing my funded accounts. So I have a model. I'm gonna show you guys after I'm done with this. I'm going over this, and my model each trade is when it's presented is A plus. When we follow A plus, no matter what. Aggressive mode, risking 2% when the model is presented. Phase 2, risking 2%. And then reduce the risk when we reach negative 4%. Risk goes to 1%. So say we're in drawdown, we're down negative 4%. We lost 2 trades. All right. You know what I'm going to do? I'm going to go and risk 1%. And I'm going to try to aim for 1 to 2s. Try to reduce that risk, as much as possible. If not, aim for a little bit higher RR. And then eventually, if we get to, we lose another 2 trades, then eventually I'll, lower it to 0.5. But even then, I'll probably just try to, get out of drawdown. But if I don't, if I'm already down to negative 7, I think I would just might as well, call it quits, start up on another funded account, unless a miracle happens. And majority of the time that doesn't happen. So passive mode here, phase 1, risking 1% until we buffer 2% or more. Then we risk 2%. Phase 2, risking 1% until we buffer. Phase 2, risking 1% until we buffer 2% or more. Then we risk 2% or more. So with the aggressive one, I'm going to risk it when I'm under, basically under 100k, when they're not 100k accounts, or not 100k. If I'm not trying to pass a 200k account, then I'm not going to, play passive. I'm going to play aggressive. Main reason why is because that's the whole point of scaling. You want to get there not as quick as possible, but very efficiently as possible. So if you have a model, if you have a trading criteria, and when you see it and it's presented and it's A plus, why not risk 2%? If it's just lower accounts and they don't cost too much, then of course risking 2% or more and following your trade plan is very important. But being in passive mode is when you're in a 200k account. You want to play it very slow and then eventually work your way into a little bit more fast paced, because if you're first time trading a 200k account, you're not going to want to be risking 2% when you first have a 200k account, your first challenge. You want to risk 1% ideal, and then wait for a buffer when you're in profit, and then risking a little bit more, so you don't get to the challenge or the completion of passing that challenge, at a very, very, very long time. You want to get there pretty quickly, but you want to have a buffer and you want to be able to risk comfortably, a good amount when you're up. So that's kind of the reason why. So passive mode is going to be on 200k account challenges, trying to pass them efficiently, in my opinion. And then we reduce the risk if we are in 2% or more drawdown. Then the risk goes to 0.5. So if we start off on the bat, in drawdown, we lose 2 trades, then I'm going to de-risk myself to 0.5 and try to get out of there as much, as soon as possible. But the payouts, of course, here are the payouts. We're only going to risk 0.5 when under 200k in funding. So for a 100k funded account, 0.5 risk until we get after that after we get a 200k account, we're only going to risk 0.5 per trade, because you don't need to risk much. You only need 0.5 to buy another 200k challenge. So if you hit a 1 to 2, you're good. If not, then you can buy a 100k account if you hit a 1 to 1 on 0.25. And that's not even bad at all either. So that's kind of why. And if you watch my other video on the scaling part, you only need a 100k challenge every month, and you need to pass that and get funded with that. And that's pretty much it. And then you reach 1 million funding by the end of the year. So it's not really as complicated as a lot of people make it seem. So that is something I'm going to try to do. And I'm going to show you guys the model now. So here we have our model. So this is going to be my trading model. It's based off of Strange ICT's model. So again, here, trading model, narrative, weekly, daily, PD array, internal to external, external to internal, internal to external. Basically, confirmation 4 hour to 1 hour, market structure shift, or market structure shift from narrative PD array or market maker X model. Entry 15 5-minute, then we get another market structure shift for a change in state of delivery from confirmation PD array, and then we use the daily range to find the premium discount entry ideal zone. Market structure shift or change in the state of delivery. This means we get a shift in market structure or another PD array pushing us away from the higher time frame one we're in. Or we get a change in the state of delivery inversion for value gap form and then move away from that higher time frame PD array we hit. Again, time frame pairing, the weekly to the 4 hour, daily to the 1 hour, the 4 hour to the 15, 1 hour to the 5 minute, 15 to the 1 minute. So if we don't have a weekly PD array and we have one on the daily time frame, if we don't have one on the weekly or the daily and we have one on the 4 hour time frame, I'm going to treat that 4 hour as my narrative PD array. I'm going to look at for internal to external. I'm going to look at, sell side and buy side external levels on the 4 hour, use my, 4 hour PD array. If not, I'm hitting an order block or a fair value gap. And then I'm going to drop down to the 15 minute. And then that's going to be my confirmation. I'm going to look for the market maker X model and then a market structure shift or change in the state of delivery from that 4 hour narrative PD array. And then the 1 minute is going to be my entry, market structure shift, dealing range, entering off of the market maker model there too. And then pretty much key elements here is going to be what higher time frame bias. That's very important. And then eventually time elements, New York. I'm going to go over that using 6-sister SMT, 3 PDA array rule. 3 PDA array rule for your stop loss, and then trailing the stop loss, and then basically seeing if order flow is being respected or not. Then you close the position after that. Those 3 PDA arrays are broken. And then, okay, the rules. 3 PDA arrays on 3 different time frames. No matter what, I have to have 3 PDA array rules, 3 PDA arrays on 3 different time frames. I experimented with 2. I've experimented with 1. I've experimented with, a lot this month during January 2024, and I realized that 3 PDA arrays maximum, we always win. If not, then we hit, a little bit in profit, break even. For reverses, of course. But if we do get onside, we majority of the time hit, like a 1 to 5, 1 to 4. And if you don't scale out, of course. But if we do scale out, we're gonna get like 1 to 2, or 1 to 3 minimum sometimes. And then again, number 2 is gonna be during New York kill zone for the forex pairs. For the indices, trading during New York sessions. So like 8:30 to 11 or 8:30 to 12, and then eventually from 13:30 to 16 o'clock for the indices. For the forex pairs, though, from New York kill zone to London close, that's when I look for my trades. So from like 7 to 12, and then after that, I don't look for anything on the forex pairs. Key takes, patience, no cutting positions too early on. I have, been having trouble with that. So I cut the positions off, especially when I'm risking like 2% in certain markets, and I get very fearful sometimes, but I try to deal with that because I've been building more trust with my model recently. So, and when I don't follow it, that's the opposite. I cut. That's why I've been cutting a little bit, because I haven't been following my model, for being completely honest. But when I do follow it, I do feel a lot more. I still feel nervous, but not as much anymore. And I've just been trying to work on that, not cutting any positions too early on and just letting it run, And again, having good risk management, using the lot size calculator. That's something I've been, doing more recently. I didn't use it before, and I think I was just risking too much. That's kind of why I've been cutting a little bit too early too. So using a lot size calculator, having the proper risk management, and again, following the model too, that's very important. Watching the economic calendar, that's something that is very important. Looking at the news injection volatility, what days are going to be probable, which ones aren't, and what to expect for that weekly power through to form. And then eventually using correlation between markets. Again, 6-sister SMT, using that, seeing which market is the best, see which one's lagging, which one isn't, seeing the correlation break, and entering on the one that is, of course, breaking that correlation, or enter on the other one that is lagging behind or something, So using correlation between markets is very important. And that's pretty much really it, how I plan on scaling, and then my model. And hopefully, by the time you're watching this, I'm already, halfway there. So to a million funded, of course. But until then, I'll talk to you guys soon. All right, pretty much here we have the goal, which is scaling funded accounts road to 1 million, and the deadline January 21st by 2025. And then you can see the current challenges we have are basically the 10K phase 1, 15K phase 1, and basically this is 25K in challenges. So we're going to work upon that, and then eventually I did the math, of course. You got to plan ahead, you got to execute and iterate. So this is going to be the scaling part. I'm going to show you guys, if I had like 5K accounts, I would have done this differently, but right now what I've got is basically the 10K and the 15K, and I'm going to approach it differently going into the second month of the year. And basically 83K is pretty much what you need to receive 1 million funding in 12 months. Pretty basic math, but we can reduce this amount because of the 200Ks. We don't need 100K strictly. Once we're scaling, of course we do, because of the cost, of course, making most of what we have and reinvesting in, buying more bigger challenges to reach the goal. To reach it by the end of the year, we have to pass 100K each month minimum. A 50K account costs $300, 100K costs $500. Just going off of like what prop firms usually, cost. I viewed multiple. Some cost a little more, less. Some cost more. It depends on, if they're having a sale or not. All this, depends. And then 200K costs 1,000 minimum sometimes. And then step 1, get funded with 25K in challenges, of course. Pass the 10K first, then the 15K. If we don't pass one of them, then of course still making use of what we got, and we're going to aim a little bit more with the payout. But as of right now, $300 is 1.5% of 25K. Suppose we need $300 to get a 50K account, but we aren't able to get that with the 10K, but we do pass the 15, then all we're going to have to aim for on the 15K is just 2%. 1% is 150, 2% is 300. So that's all we're going to have to aim for. But we do pass. Eventually just aiming for 1% on each account will be good enough. So 150, and then eventually $100. So then that would be 250, but then we're going to aim for a little bit more. So probably 1.2% on 25K. So around like 1.5%. So aiming for 1% on this account, and then like another like a little bit extra over 1%. But I think the Funding Next does pay you for your challenges phases, like phase 1 and phase 2. They pay you a little bit more, so we're going to receive a little bit more. We're going to reinvest that into a 50K account. So then step 2 is going to be buy a 50K challenge, pass it, and get funded. And then 25 plus 50 is going to equal 75K. So $500, which is a 100K account, is going to be 0.67. So it's not even 1% of 75K. and then we're gonna have to make 0.5 on each funded account minimum on each one of these, from the 50k to the 15 to the 5 10k. 0.5 on each one, taking just a small trade, 0.5 risk, 1-to-1, cutting it right then and there, and then going to receive the payout, and then eventually proceeding to step 3. Here we're trying to play very safe, Here we're trying to play very safe when we're funded, because it's very important to play safe and not aim for the big shots. Once you aim for the big shots, that's where you start to blow the consistency and you start getting euphoric, and that's where all the mistakes tend to happen. And then eventually, after we get the 100k account past that, get funded, we only have to make 1% to get a 200k account minimum, but 1,000 equals 1% of the 100k, and then 1,000 equals 0.5 on the 175k we're gonna have total. So making 0.25 on each challenge account, then eventually is gonna add up and compound and eventually pass us this account. That's how it's gonna be. If we make 0.25 on each account, it's not that much, I promise you. Or we can just aim for 1%, hit a 0.5 or 1% risk, 1-to-1, take that, go get the payout challenge account. Or we can aim for a 0.25 or 0.5 risk, go 1-to-1 on all the challenge accounts, and then once we start, wait for the payouts for every single one of them, and then call it buying a 200k. All right, after step 4, everything gets really, really easy. After you get after you pass a 200k account, you're gonna have to maintain it. You're done with the scaling part, since you already have one 200k account, and you're gonna be with basically 375k if of course if you don't do this, but for right now, for me, 375k, only 625k left, which is basically 4 200k challenges in my opinion, which costs around $4,000, and 4,000 is 2% on a 200k account challenge. I know, but if we do just aim for not all the challenges, but one challenge, is going to equal 0.5, which is not too much. 0.5, 1-to-1, we going by the other 200k challenge, playing it very safe. Again, playing it safe here is very important. And then after step 5, everything just gets really easier. There's no point of risking too much at the end of the day. After step 5, we buy another 200k challenge. We're gonna have 575k funded. We're halfway done with the plan, and we should not be rushing it. We should not be trying to buy past challenges anymore. I think after this point, you really just start to compound it, and then you don't have to worry about anything anymore, in my opinion. 3k is 0.75 of the 400k funded, so the 200ks is going to equal 0.75. So aiming for 0.35 risk, I think that would equate to 0.70. So aiming for just 0.4 or 0.5 risk and hitting a 1-to-1, that's basically an equal percent on both of the accounts. And then we can buy 3 challenges. But if we want to play safe, 2,000 is only 0.5 of the 400k funding. So we can buy 2 challenges right there. We're going to be up around, I think, 900. We're going to be very close, but nonetheless, that would be a lot more. Or 0.25. Another 200k, we're going to be at basically, I think, 700, and then we're going to just keep doing that, playing 1 by 1. But I would prefer to buy 2 and then buy another one, and then just finish it off right there with that one, or get a 25k challenge and have a mil funding right there. But I would prefer to just continue scaling. I think that would be the best point. Just continue to scale, and then eventually just continue to develop, in my opinion. There's no point of not doing that. So I think this is my plan for how I plan on doing it, and pass funded accounts here soon. Peace.